Good day, guys. Welcome to another exciting episode of the WealthWise show. I'm your host, the Wise Investor, and join me as we navigate the world of personal finance and equip you with the knowledge and tools to make wise financial decisions. Now, let's dive into today's episode of the WealthWise. So today's episode is more of a part 2 from last week's episode. Last week we talked about, different ways you can research companies, looking at the different stocks and ETFs and seeing what analyst says about them. That's a little bit of fundamental analysis, but I want to go in more detail this week. So this week, this episode is going to be called Mastering the Market. How about that? So yes, this little short 30-minute episode may not actually make you a master of the market, but it should unlock some insight for you to how to discover and evaluate a company's financial health. So, you ready? Let's get started. So first thing first, I want to talk about a little thing that you might hear all the time if you watch financial news. Like, if you watch CNBC, or you listen to, the financial gurus on YouTube, or even this podcast or other financial podcasts in this space, they always talk about PE ratios. Now, when you're talking to an investor, like a seasoned investor or someone who is in the industry, for professionals essentially, of course they're going to know what PE ratios is. But you, the average listener, may not know. So what is a PE ratio? Well, it's a ratio. It's price to earnings. So basically what it does is it values a company by its share price relative to its earning price per share, or EPS. So that's essentially what the price to earning ratio is. So essentially, why PE ratios are important? Well, because the higher the PE ratio, means the stock could be overvalued, or a lot of growth companies that we see today, like Nvidia, this month, and things like that, they have high PE ratios because the people who are putting their money in there is expecting a higher growth in the future. So typically when you have high PE, I was about to say pH. Well, if you have high PE ratio companies or stocks, when that number is really high, you're looking at either a company that's overvalued, or a company that is promising that it's going to be worth it in the future. And typically, sorry about that, my wife was calling, but like I was saying, so PE ratios, typically the companies who have higher PE ratios, they overvalue, or sometimes they are expecting higher growth. So the formula, since I said it's a ratio, meaning there's a mathematical formula for the PE ratio, and it's very simple. It's division. So you take the market value per share, divide that by earnings per share, and that sounds super simple. Well, it is. So what you do is you divide the current stock price by the earnings per share, the EPS. Now, the EPS usually comes out during earnings. So when, at the end of the quarter, when companies do their earning calls and, display their financials for their investors, they will give a EPS that you can, take a look at. So the PE ratio is one of the most widely tools that a lot of analysts and a lot of institutional people use, and a lot of retail investors as well use these all the time, whether, to determine whether a stock is, overbought or, oversold. But you can also use the PE ratio against indexes like the S&P 500. So, the S&P 500, you're like, well, how can you use it against the S&P 500? Well, you definitely can. It's the same thing, same formula essentially. S&P Global is one of the companies that, runs or handles the S&P 500. And if, the companies in the index, let's say their P ratios are going down, well, there you go. So, or vice versa. So that is a very super simple, super simplified meaning of the P ratio and how you will want to use that. Let's say you're looking at, I'm not talking about growth companies here, because growth companies are always going to have a high PE ratio. And your growth companies are probably tech stocks and stuff like that. But let's say like a company like, P&G. P&G is Procter and Gamble. They manufacture pretty much everything probably in your house, from consumer, you got your goods and all that stuff. They do all that, your toothpastes, your toilet papers, all that good stuff. So P&G, they are going to have I would say a moderate PE ratio, because it's not super high growth. They're pretty stable. They're not like, super high. I want to say beta, but that's a term that I'm going to explain later. But, not super high beta. And, usually there's not that volatile, which is basically what I just said. And their PE ratio is around 24. That's pretty nice. Now, if you look at a stock like, let's say Nvidia, because that still is the hot topic. So you look at a stock of Nvidia PE ratio is 208. So 208 versus 24. And then you can see how, different companies have different PE ratios, and how you can determine if a company is overbought or oversold. Now that's not like your all telltale sign that, hey, this company, I want to buy it, and I've been patient. The PE ratio is this. I'm going to go ahead and buy it. There are some other factors you might want to look into. Now, if you want to go a little more deeper, let's say, you can look at the debt to equity ratio. I'm not going to spend so much time on that. But pretty much is very similar to the P ratio, where it is a mathematical ratio formula, and you just take the total liabilities and divide that by the total shareholders' equity. And you can find, I know some brokers do offer that information in the financials of the company. So you can look at their 10Ks, 10Qs. And I know that might be like, what, Derek? And I know some of you guys might be like, what? The Wise Investor? I don't know what you are saying about all this stuff. 10Ks, 10Qs. What? Are we running now? So if that's a little too much, then just look at the PE ratio. If it's, if it's a growth company, if it's high, you can look at a PE chart too. And, it's like, like I said, Nvidia is, 208, that's really high. Then, might not be a good time. Combine that with let's say the chart. So if you look at the PE ratio and you look at the chart, and it's like, skyrocketing, going to the moon, as the kids would say, then you might not want to, dabble in it at the moment. Of course, take this with a grain of salt and talk to your financial advisors and, consult your, money managers and things like that. But yeah, you might want to think about it more intently if you want to get in right now. So I like PE ratio. That's something that we use. It's a nice little formula to, and if you can interpret them right, it'll help you make an informed investment decision. So, and the next thing I'm going to talk about besides PE ratios, let's just go with the basic old stock chart. So this is an audio format. We are working on the video side, so give me some time. The video side is going to be on our YouTube channel, the WealthWise show. Just type that into YouTube and hopefully it comes up. We don't have no videos yet, but let's just talk about, a basic chart. So one of the charting tools that I really like, I'm not affiliated with them, nor am I, getting paid. I'm not sponsored by them, but it's just something that I personally use for my charting because I think the charts are pretty. And that is TradingView. And TradingView is a software that you can use on your browser. You can download the app on your phone, so you can always have a chart ready at your fingertips. So I'm going to open up TradingView right now, and we're gonna look at Apple. And I know, the visuals will be really good for this. Don't worry, guys. I'm working on it. I might throw in some visuals for this. But let's say you're, looking at a basic line chart, and you see, hey, the stock I want to get into is going vertical, going straight up, and the P ratio is higher than I've seen the last time I checked. Well, if it's a high P ratio, you might want to think about if it not only a high P ratio, but if it's also like skyrocketing. Like I'm on the Apple chart right now, and Apple is nearing all-time highs. It's like, almost there, probably like a $2 off of all-time highs. Would I want to buy that? Me personally, I wouldn't buy that because, yes, I know I said in episode 1 and 2, if I'm gonna hold these stocks for a long time, it doesn't matter where I buy it at. But I was really talking about the index, like the S&P 500. And for those of you who have been stuck it out with me until the 4th episode, and you're like, what is the S&P 500? You've been talking about this. The S&P 500 is essentially 500 of the best companies in the world, all in one index. It's all in one place, and they will kick out a company that's not doing so hot, and they'll bring in a company that is doing hot. So the S&P is like, the benchmark, the Michael Jordan of, the stock market strategies. So it doesn't matter when I buy the S&P 500 because it's always going to have the best, allocation, the best strategies for now until, of course, maybe another index come out later on in life that beats it. We don't know. But as of right now, it's the best. So if I'm talking about a single company like an Apple or a Microsoft, a company that's, is whether it goes up or not depends on the performance of the company. Yes, I would not buy the companies. I'll be a little more strategic. I hope I said that right. I will add a little more strategy towards, if I'm going to buy at the all-time highs or not. And 9 out of 10 times, actually 10 out of 10 times, I'm not going to buy at the all-time highs. So you say, okay, Derek, the P ratio is high and we're near all-time highs. Well, when do we buy? I'm glad you asked. So if you go to any brokerage, let's say you are even not even just any broker. Let's say you go to Yahoo Finance. You don't want to use TradingView. You rather just go to Yahoo Finance. That is great. Another great tool. If you go to any chart, it should have the dates at the top of it are near it, where it'd be 1D, 5D, 1M, 6M, YTD, and that stands for 1 day, 5 day, 1 month, 6 month, year to date. Y is 1 year, and so on. So let's say if you're looking at an Apple chart, and you say, well, Derek, we're near all-time highs. Did it again. The wise investor, we're nearing all-time highs, and I really want to get in. It looks really good. It looks very ripe for the taking. We're gonna break out. Basically what a breakout is, we're gonna go higher essentially. Well, you can just click on that 5 day, or that 1M, and you can just see, okay, what is the percentage? How much are we up? Are we really that high up? If I go to an NVIDIA chart, if I just Google NVIDIA, the ticker NVDA, and I can even go on Google Finance, go to 5 day, it'll tell you, hey, the last 5 days, NVIDIA is up $91 or 91 points, or 29%. In 1 month, it's up 38%. In 6 months, half a year, it's up 134%. That's amazing gains, yeah. But that's really high. So what I would like to do is, okay, if I know it went up in 5 days 30%, and I feel hey, this is a little too expensive. Well, it might not give back the whole 30%, but it might give back half. It might just give back 15%. It might give back 10%. So if it goes down 5 to 10%, I personally will buy a couple of shares, as it goes down, and I'll keep buying a couple of shares until, let's say I have a price that I feel like is worth it. Now, a lot of you guys who are maybe listening, you might not have a price. You just be like, hey, I just want to buy. Well, what rule of thumb is, not rule of thumb. Well, my rule of thumb is dollar cost average. Well, not just my rule of thumb. Is a rule of thumb in the industry, dollar cost average. So if you're buying, fractional shares or whole shares of the S&P 500, buy fractional shares of the company that you want, little by little, every month. And if the market is a little too high, you have to understand that it may drop a little bit. You can't really time the market, but it may drop a little bit, but still put something in. If you put $100 in every paycheck, just keep putting $100 in and don't look at your account. Now, if you are constantly looking at your account and constantly, being a hawk, you're probably going to make decisions that you don't want to off of emotions. But these are some of the tools that a lot of professionals use to determine whether a company is good or not. And low P ratio companies doesn't mean they're bad. And high P ratio companies doesn't mean they're good. But that's just one of the tools that you want to look at. And, I did say I was going to talk about beta. Now, there is no, if you go to a stock chart, you're not going to see beta anywhere. But beta is essentially the volatility. Typically, a high beta stock is a stock that, is very volatile, like Tesla. It moves, and can you handle those movements? Can you handle those days where, it goes down 10%? Those are you got to be honest with yourself. Hey, can I handle that kind of pressure? And if you can't, if you're down 10% in one day and you get an alert on your phone that say, hey, you're down 10% on the day from this stock, can you handle it? So when you're thinking about investing, especially in the equity market, I would say the equity market is a young man's game that the older generation participated when they were young. So, if you have, let's say you're 20, 21, you're just starting your life and you're building equity with stocks, by time you're in retirement age, you already built that equity over those years. So now you can focus on more income things like, bonds and, annuities and preferred stocks. Those are things we're going to talk about eventually, but those are considered income driven. So, let's say you built a certain lifestyle, you can maintain that lifestyle easily and still keep your equity by those things. So, if you're young and you're listening to this, even if you're, nearing retirement age and you're listening to this, and if you haven't built any equity, if you haven't bought any stocks, think about it. And depending on your time horizon, that is something that you should take in consideration. When you're older, let's say you're 59 and you're not quite at the half, but you're at 59, you might want to think about, what should I do? Should I do 50-50 where I do 50% equities, 50% fixed income? Should I do, I'm talking about for people who haven't built up equity, from a young age. You got to start somewhere. But if you, let's say, have a pension or you have a 401k, that's been built in equity, building equity for you, depending on where you put, designate the money to go. And you can use that. Like if you have a chunk of change for retirement, you can do a lot with that to, help you grow your equity side and your fixed income side. So just like I said, guys, talk to a financial professional in your local area and see where, where they can help you out at. So I know I didn't really go into great detail because I'm trying to keep these episodes, bite size, and I want to talk about one particular thing and one overall theme and tie it all together. And that's my goal of this, to partake too, but impart some enlightenment, some wisdom to those who are looking for it. So, no, I got time. For some more stuff. So, all right, we talk about PE ratios. We talk about, looking at the charts and seeing, if the percentages are super high, when should I start looking into buying, when they start coming down. Let's just talk about some news. Why not? Sure. Why not? So, I know one of the biggest things that people are on people's mind is the debt ceiling. Now, by the time you guys hear this, the debt ceiling more likely have passed or didn't pass. I don't know. And I say I don't know because I'm recording this. It's still in May. So I don't know. But one of the biggest things that I've noticed, there's a lot of fear going around whether the debt ceiling pass or not pass. And I get it. I would be fearful too. But one of the things to keep in mind is time is just going to keep going. So I know worrying is something that a lot of people do. I myself am a victim of that. But overly worrying can be a big crutch. So let's look at what it said. The U.S. debt ceiling faces a tough pass in the House as GOP opposition grows. So whether it pass or not, more likely it will pass eventually. If it doesn't pass, it eventually will. America is just not going to go bankrupt. That's not how that works. But I wouldn't worry about it too much. I know people want to use it for clicks and things like that. But talk to your financial advisors and, use some deductive reasoning. One of the things that we like to do in financials is look into the past. Like if I want to look at a company, I go look at the history of the company, and that gives me an idea of what may happen with the company in the future. So try that. Have it ever happened before? And when it came close to it, what happened? So I know we're in an ever-changing landscape, but I like I said, I'm the wise investor, so I want to impart wisdom. And if you are worried about, your stock portfolio, there are plenty of avenues to protect yourself from that. Talk to your money managers, talk to your advisors, see what tools that they can implement to protect your equity portfolio without you having it sell, depending on your cost basis, of course. And see, if you have a little, change, think about fixed income, debt, bonds, and, things like that, things that pays a percent every 6 months or every month. I wouldn't lock it up in CDs depending on, if your liquidity needs, like if you need the liquidity, I wouldn't lock it up in a CD, but there are plenty of savings accounts that are high yielding now that the rates are really high. So there's plenty of ways to get yield, plenty of workarounds to focus on, getting that yield. You just got to go find it. It's a little tougher, but I want to say, if you're looking for somewhere to put your money and you got some cash, you don't want to put it into the market. Money market accounts seems to be the way to go. They're usually accounts that, on the fixed side, short dated debt. So meaning, let's say like 1 month, 2 month, 3 month, you know what I'm saying? Like you'll get that money back in 1 month, 2 month, 3 months, bills and stuff like that. Put some money in that, and just let it sit until all this is settled. And cash equivalent products, things like that. That way, take a peace of mind. And since the market is roaring at the moment, we're up at the moment at the time of this recording. You can, shave off some, put in a money market account, and still leave a little bit left. So hopefully I imparted some wisdom. I gotta get ready because I got an appointment to go do in a few minutes. So guys, man, 4 episodes in 1 month. Wow. I'm going to keep it up. I appreciate all the support, guys. I appreciate, the likes, the messages, the tweets, the Instagram posts, the comments. I really do appreciate all the support that I've been getting on the WealthWise show. And I hope to, upgrade some stuff and, continue to provide the best entertainment, I guess, that I can. So that wraps up another enlightening episode of the WealthWise show, guys. Hope you gained some valuable insights and practical tips to control. Let me do that over. And that wraps up another enlightening episode of the WealthWise show. Hope you gained some valuable insight and practical tips to take control of your financial future. Remember, guys, financial education is a journey, and I'm here with you. If you have any questions or topics you'd like us to cover, feel free to reach out to me on any of my socials. The WealthWise show, at the WealthWise show for Instagram, YouTube and things like that. Don't forget to subscribe to our YouTube channel and our podcast wherever you listen to them at, so you can stay up to date with the latest information. that we will be posting. And together, let's unlock the doors to financial independence and live our best lives. Until next time, guys, stay wealth wise.